In this week's update, get the process right, add discipline, and good outcomes will follow. Critical Fed meeting next week, and it's the same message as I delivered last Sunday. No action required except a heightened awareness or readiness if the market does turn. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Really important investing perspective this week. So we'll start with, how do you know if you have the process that is right for you, that is going to deliver the sort of results that you want? So these are some of the things to perhaps check and see if this applies to you, or maybe, as in the next slide, the opposite applies to you. So do you tend to focus on managing risk more than you do on profit? Are you relaxed during downturns in the market, not concerned if the market goes down for a few weeks, a month, a couple of months? It doesn't really affect your game plan. Do you really feel the need to just do something, anything, because you feel nervous, anxious? Do you have a feeling of what I would call quiet confidence? It's not overconfidence, it's not arrogance, because those things can very much lead to switching off and just assuming that everything will continue as it is. So it's just a feeling of quiet confidence that over time you're on the right track. Are you organised? Have you got clear, well-researched targets? Do you know what the entry bands are or what your entry conditions look like? Do you know clearly what your exit triggers look like? Even more important, really, than the point before, because that's where most people get themselves into trouble. And is it producing the results that you want? So they're all the checkpoints that you could consider to know whether you've got a process that's right for you. On the other side of the coin, what does a focus on the outcome look like? So if you're someone who focuses on trying to get a particular outcome rather than the process that leads to it, then what does that look like? What are the elements? Well, you're never really sure what your stock will do in a general correction. You're nervous, you're uncertain. Every time the price goes down, you get even more nervous. And a lot of people tend to have a victim mentality. They feel as though they have no control over their investing, that they've just got to accept what the market dishes out to them. You always feel like you should take the profit and run. And as a consequence of that, you never ever seem to get the really big winners. The 3, 4, 5, 10 bagger kind of outcomes over a period of several years, they never appear. Feels like you're more aligned or comfortable with the crowd. So if those things apply to you, then it's almost certain you've got much more of a focus on the outcome and not on the process. And that will almost certainly not deliver you what you want. So if this is you, if you are focused on the outcome and not on the process, then what are you going to do to dramatically change that and improve performance? Because unless you do something different, then you're going to keep getting the same result. That's reasonably logical. Now, the message is that I've been delivering this message for years, is that getting on a good track is relatively straightforward, but it's not necessarily easy. In fact, it isn't easy, because the biggest block as investors that we've got to real success is what's running around in our head. And if you don't have a track to run on that's simple and repeatable, then you're just not going to get the results that you want. Staying on the track requires some guidance for 99% of people. There's very few people who are in a position, either within their life structure or mentally, to perform on their own, to function on their own without some sort of additional external guidance. And I need to point out that this doesn't need to be costly personal advice kind of guidance. You just need to make sure that you've got the right inputs that can help. So where do you find that sort of guidance? Because again, what I hear over the years is a lot of investors just don't know where to go to get the sort of guidance that they're looking for. There's a couple of checkpoints again that you can use. One is the absence of a vested interest in the information or the recommendations you're being given, or alternatively, that the organisation that's giving them has controlled directives, you might say. Their advisors tend to be constrained in what they can recommend, and that generally doesn't lead to good outcomes. You certainly want to be tapped into someone or an organisation that conducts independent research, and going with that is decades of experience, because if you haven't had decades of experience, you just haven't lived through the cycles that are necessary to understand how markets really operate. And the final point I would touch on would be that independent research has got to be open-minded and responsive to the market and the changes that are occurring, or the challenges that are occurring. So there's some things that you can consider to know whether you're on the right track and whether you need to make any changes, because this is the most important first step. This is far more important than the next recommendation, because the next recommendation is not worth very much if it's in the absence of a clear plan, a clear track to run on, a clear exit strategy, all those sort of things. We also advise, of course, that you get all the other independent advice that you need, be it financial, legal, or any other advice before taking action, because it is just so much easier to lose money in the stock market than it is to make it. Let's look at American stocks now. For the week, the S&P was up almost 1.5%, and the NASDAQ around about 1%. So it was a bit of a different week, where the NASDAQ was positive but underperformed. Now, we're in a US earnings season, and there's brutal treatment for any company that misses expectations or misses the guidance that they've provided. So that's something to just be aware of, that some of the stocks that you own may be about to report. So be well worth just checking when that reporting date is, and if the price is sliding into that earnings report date, there's a reasonable chance that Wall Street knows that something is amiss. Overall, the character of the US market, I have to say, in the last week or two since earnings season started, has just shifted a bit to skittish, but there are still some outstanding results that we're seeing associated with the earnings. So the market's not shy to reward the companies that are exceeding guidance, and exceeding guidance on outlook as well. But you need to make sure that you're in that category and not one of the companies that is missing. So we're going to see, I think, a significant difference between the haves and the have-nots during this earnings season. The US dollar index was at 97.67. The yield slipped a little bit down to 4.39, but the VIX did drop below 15. So we're really getting down now into complacency territory. All right, let's look at the indices for the US market. This is the NASDAQ composite on a daily chart, and you can see it's just continuing to progress. The daily ranges are getting very small. So if you look back here in the early part of the recovery through May, we had gaps, we had longer range candles, and if you add the gap onto that, it makes the ranges even longer. But you can see just of late, there's been quite a shift since the end of June, where the daily ranges have got much smaller. This is a market that's starting to look like it's getting a bit tired, and we're losing momentum, even though the market is still rising and it's still holding above the 8-day moving average. The fact that the daily ranges are getting shorter, we've got some long tails, top and bottom, it's all leading to uncertainty and indecisiveness. If we look at the NASDAQ versus the S&P, there hasn't been a lot change there. As you can see, we backtracked just a little bit on that ratio last week because the S&P did a little bit better. This is consumer discretionary versus staples. Not a lot of change there either. S&P versus gold continues to rise because gold slipped a little bit while the S&P went up. Importantly, the semiconductor sector has broken out, and over the last 3 weeks, this is a weekly chart, so we've had 3 weeks of breakout now, and we're still getting some pretty solid price advances in that sector. If we look at it on a sector-by-sector basis, over the last month, we've now got materials has now moved to the top, followed by consumer discretionary, and then technology in third place, and then followed by the banks. Now, the banks have generally had a pretty good time of it of late, and you can see the banks have moved up quite quickly since earnings season started with the majors, JP Morgan, Wells Fargo, etc. So that's what it looks like on a sector-by-sector basis. Down the bottom, we've got consumer staples. So we've still got a market that is prepared to put money more into the aggressive sectors of the market. Turning now to the Australian sector outlook, energy has done well at the top. Information technology is still right up there as it has been for a while. So those two sectors have been doing very well. But next we've got small caps and then healthcare. Now, healthcare did improve quite sharply last week, so it's coming up from a pretty low position in the pecking order. And finally, finishing off with the S&P. So this is on a weekly chart that shows that we're now 4 weeks into the breakout on the S&P. So the fundamentals around the American market and earnings season are quite solid. There's nothing really nasty there at this stage. And technically, the charts are looking fine. This is a weekly chart. Now, if I put this on a daily, the same as the NASDAQ, you can see that we've got a similar sort of situation where since the end of June, the candle ranges have generally got quite a bit smaller. So it's this loss of momentum that needs to be watched closely in the American market. Now, turning to the Australian market now, the Aussie dollar finished 65.5, so some reasonable strength during the week. The manufacturing sector in Australia remains pretty weak, and it's only around 5% of GDP, and that impacts the resilience of the Australian dollar. So that is a long-term trend that is certainly not helping the Aussie dollar. And then on top of that, we've got the shorter-term issues with tariffs, the uncertainty around tariffs, and also the BRICS countries expanding into other trade relationships that's also impacting global currencies more generally. So it's pretty hard to anticipate where global currencies are going to be heading over the next couple of years. All right, let's look at the Aussie market, and we'll start with the ASX 200. This is a daily chart. So we had a breakout the Friday before last, the 18th of July, and then it was really just very much an up and down week. So that breakout from the 18th of July pretty much got washed out, most of it, by the end of the week. Now, we may get a positive start on Monday morning in our market because the US market did finish reasonably well, but this is a breakout that may be on the cusp of stalling, and particularly when you look at some of the rotations. And one of the biggest rotations that we've had is from the finance sector into the mining sector. And it's likely, this is a weekly chart, so this is a pretty emphatic downward week for banks. But we have recovered from them before. We had a significant down week at the end of February of this year that led to a shorter term downtrend. But you can't ignore this sort of reversal. And from my perspective, from a valuation perspective, it's about time, because the banks just seem ridiculously overvalued compared to the long-term norms. So banks down, miners were up, and again, this is a weekly chart, but did close well off their highs as well. So some good short-term momentum, but not really being sustained. And if we look at healthcare, also a good week for healthcare, 2 weeks up in a row. Good part of that has been around the advance of CSL. And information technology, also on a weekly chart, is just on the cusp of setting new highs and a breakout. So that is also a sector to watch. Now, the currencies, the US dollar index managed to jump a little bit on Thursday and Friday, but closed well off the highs on Friday. So there's nothing terribly emphatic about that. And there's the Australian dollar, just very gradually working its way to the upside. All right, so we were down just a tick over 1% for the week, and with that significant rotation from banks into miners and healthcare. But as I keep observing every Sunday, underneath the hood of the ASX 200, there are some wonderful small to mid-cap companies that are producing exceptional long-term returns, well above the long-term average for the index. So there is certainly positive places, lots of positive places to invest in the Australian market. Turning now to precious metals, gold was down $12. It was a bit of a shaky week, down to $33.37. Did get up above 3,400 at one stage. Translate that to Aussie dollars, we've got 5,083. Silver got to 38.16. It ended up a flat week, but it was quite a negative finish. So finished the same as where we were, and I think it got above 39. Have a look at that on the charts in a minute. So it would seem that as trade deals get done with Washington, that the luster of precious metals, or the fear premium around precious metals, is wearing off just a little bit. If we look at gold stocks, the index in Australia, GDX, was net higher, but it was quite volatile for the week. And we saw some conflicting reports and reactions from the market at two different ends of the spectrum. Northern Star has been marked down quite savagely, down by 30%. But late in the week, last week, Newmont reported, and the report was very well accepted by the market, and the share price rose 4% on the day. So let's go and have a look at those particular sectors. So first of all, we'll start with silver. So silver, this is on a daily chart. So silver did peak on Wednesday to just over 39.5. So a lot of strength, but lost plenty of ground on Friday, I should say. But overall, net stayed where it was for the week. So I guess it could have been worse in an environment that geopolitical premium is starting to come out of precious metals a little bit. But look, when you stand back and look at that, the trend is still up. The green line is the 20-day moving average. We're still comfortably above that. So this still rates as a strong trend at this stage. In US dollars, again, daily chart, 3 days down to finish the week. And we did get up at one stage to form a big quadruple top, and the market has rejected from that level, which is around about the 34.50 mark. And there we are in Australian dollars, cushioned a bit by the currencies. And just finishing off also with Bitcoin, got a little bit volatile on Friday, but still finished clearly off the lows. Now, if we go and look at GDX, the Aussie index in Australia, this is a weekly chart. You can see it was positive for the first part of the week and then somewhat negative. But if we go and look at the two stocks that I referred to, one of which was Northern Star, then you can see the price has tumbled from nearly $23 and closed the week at 1580. So that was a report that disappointed the market. And I think it's the very significant increase in capital expenditure, sustaining capital, that has surprised the market a little bit. The other one to look at is Newmont, which came out with a very well-accepted report. Their earnings for Q2 was $1.43 US. Their production is on target for the guidance that they'd provided of 5.6 million ounces. Their free cash flow was a record, 1.7 billion, which was up 42% quarter on quarter. This is what I was expecting more from the majors, and it was surprising with Northern Star to get the report that we did, and the market reaction obviously reflected that. The all-in sustaining cost for Newmont is $15.93, which is lower than it had been, and that's really reflected by the fact that they've got lower expenditure for sustaining capital as well. So two very different reports and two very different market responses. All right, turning now to the other commodities part of the market. Copper was at $5.78. The big question, of course, is this sustainable? How much of the rise in copper is this looming tariff deadline on August 1st? I would suggest probably quite a bit. So what happens after the 1st of August is a bit problematic at the moment. Crude oil, 65.07. And we've got a really mixed picture with crude oil at the moment. We've got OPEC planning increases for August and September, so that would tend to put downward pressure on the oil price. We've also got the US has reinstated Chevron's license to operate in Venezuela, which is one of the biggest, most prolific oil-producing regions. So that would also tend to put downward pressure on the oil price. But then we've got Russian sanctions that would tend to put upward pressure on the oil price. So we've got a fairly confusing picture and geopolitical picture as we normally have with crude oil. So overall, I think the reasonable expectation is that crude oil is going to get stuck in this $65 to $70 range for the foreseeable future. There's the copper price chart, so quite a strong week. And there's the crude oil chart, just hanging around that 65 level. All right, that's it. The final thoughts to wrap things up for this week. Backing momentum works. In fact, if you're investing without some degree of momentum, then you're trying to do the opposite, which is called bottom fishing, and that is inherently unreliable and can blow up in your face very badly, because some trends are going down because companies are running into severe trouble. So having a degree of upward momentum in the stocks that you own is important. However, whilst that's momentum, existing momentum is a key part of what fuels an advance, you've got to be very careful, because it's all too easy just to switch off when things are going well, when you've got upward momentum, and just forget about risk management. So how do you go about avoiding that inevitable trap that at some point when you've got strong upward momentum, that the market just gets ahead of itself and there will be an inevitable correction, and sometimes that correction can be savage. And if you look at the world's great advances over the decades, the Microsofts and the Apples and stocks of that nature, even local stocks like CSL, for instance, they all at some point pull back between 30 and 50%. So if you want to invest in these companies to allow the time frame to play out and get the really big wealth generating returns, how do you avoid the inevitable trap where the price is going to go into some sort of substantial decline? And the answer is that your exit system has to reliably be able to take you out relatively early, at least early enough for what you're looking for. And in my experience of applying exiting systems over the decades, and I've tried trailing stop losses and all of those sort of things. I've tried every exiting system known to man. But they all have failures in various respects. And so the processes that I've been using over the last at least 5 years have quite unequivocal triggers. They're not slavish mechanical rules like trailing stops, because I find they often don't work. Where the trailing stop is indicating that you should get out is often very close to a point where you should be looking at buying in. So I never had the feeling that trailing stops were serving me very well. So this is an exiting system that is clear. There's no question about whether the trigger applies or not. And it does get you out earlier than anything else that I know. So that's what you require to be a successful long-term investor. You don't want to get out early. You want to allow great stories to unfold. But if that great story is going into a significant reversal, then you want to have a mechanism for getting out. And the other reality, whilst it's so important, is the old 80-20 rule, and that is that something like 80% of your yearly profitability is going to come from something like 20% or less of the assets that you own. So you've got to allow an environment, a process that allows those great stories to unfold and really contribute significantly to your wealth. But you don't want to give too much of it back when the inevitable big correction comes. Portfolio analyst last week was around lithium stocks, looking at the question of whether this rise that we've seen in the last few weeks is real or is it false? Is it just another false start and lithium is still an asset class for the more distant future? All right, that's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.